rings true. Now, we've covered how to recognize systemic risk and how to sidestep it, and we've talked about how to profit from mini crashes. How about the rest of the sell-offs we experience? The garden variety pullbacks, those are the most common types by far. What causes these declines? Well, there are a bunch of different varieties. First, you've got sell-offs caused by the Federal Reserve, probably the most important because they're top of mind, and that's the most frequent reason for stock dumping. There's a reason the business media is constantly talking about the Fed. When the economy is weakening, the Federal Reserve's job is to try to restore growth. As long as the Fed is cutting interest rates, almost every decline is a viable one, unless there's systemic risk, of course. It's just a fact of life. It's been like that since I got in the business. But when the economy is strengthening and perhaps even overheating, the Fed has a different mandate. In an expansion, its job is to temper growth in order to stop inflation. And look, the Fed is right to be worried. Inflation erodes the purchasing power of individuals. It makes it so your dollars buy fewer and fewer goods, and your savings are less likely to cover your long-term needs. But we don't want the Fed to break the economy. And here I'm talking about the BREAK kind, like it did when it raised rates 17 straight times in lockstep going into the Great Recession. Now, there are plenty of times when the Fed's tightening and the stock market wasn't crushed because the economy wasn't crushed. However, whenever the Fed tightens, some prognosticators will come out of the woodwork to tell you the market will crash or at least take a very big header. It's inevitable. So when you hear or read these comments, do not panic. Fed rate hikes don't necessarily lead to crashes. In fact, I've seen plenty that do next to nothing. But there are rational reasons why the stock market should and does go down when the Fed raises rates. First, stocks are only one of the assets available to individuals and institutions. There's gold, real estate, of course, the bonds. I like gold as a safe haven, and I believe that every person should hold some gold, preferably bullion. But if not, then the GLD is a hedge against inflation. But otherwise, as we've seen, gold hasn't been able to protect you against much in the last 2 decades. Consider it a hedge against a catastrophe that hasn't yet occurred. Real estate, actual real estate can be a good hedge, but most people don't have the money to invest in the kinds of real estate that big institutions can buy. Now, we do have real estate investment trusts, but they're not reliable as a proxy for real estate. Finally, we have bonds as an investment alternative, and bonds are the source of the problem when the Fed raises rates. As the Fed tightens, bonds, particularly short-term pieces of paper, become more competitive with stocks. You'll notice that as the Fed jacks up rates, high-yielding dividend stocks are going to be among the worst performers. That's because their yields suddenly look a lot less attractive versus what you can get from bonds, and their stocks are inherently more risky than treasuries. So please be careful of these stocks as safe havens when the sell-off is caused by the Fed. They're very different from accidental high-yielders that can spring back when the Fed is tightening. The second reason why stocks can go down legitimately when the Fed raises rates, because the Fed isn't perfect. I keep talking about those 17 lockstep rate hikes. Well, because the Fed isn't perfect. The Fed kept tightening and tightening long after it should have stopped. They've raised rates when they should have stood pat because the economy was already slowing, or even cutting rates fast because of what was going on underneath. When that's the case, sell-offs can materialize going to the Fed meeting, and then the pain will continue after. You get that kind of pullback, and you need to be extra careful not to be aggressive buying any stocks, especially the defensive high-yielding bond market. Alternative stocks are not going to work. Here's the bottom line. Garden variety pullbacks can be gamed as long as there's no systemic risk. But sell-offs in the wake of the Fed raising rates, those are trickier, although they can lead to decent opportunities, as long as you stay away from the high yielders that become less attractive when the Fed tightens, and stick with the accidentally high yielders that might just give you that delicious bounce when the Fed is done tightening. Mad Money's back after the break.